Why does the federal funds rate change affect home loan rates? Imagine you're planning to buy a house or refinance your current mortgage. You might notice that mortgage rates seem to change from month to month. Ever wonder what causes those shifts? Well, one big factor is the federal funds rate. Let's explore how this tiny but powerful interest rate influences the cost of borrowing money for your home. The federal funds rate is the interest rate at which banks lend money to each other overnight. It's set by the Federal Reserve, which is the central bank of the United States. When the Federal Reserve raises this rate, it becomes more expensive for banks to borrow money. Banks then often pass these higher costs onto consumers by increasing the interest rates on loans, including mortgages. When the rate is lowered, borrowing becomes cheaper for banks, and they tend to lower the interest rates they charge for home loans. But it's not a direct one-to-one connection. Mortgage rates are more closely tied to long-term bond yields, especially the 10-year Treasury note. These bond yields reflected what investors expect about inflation and economic growth over the next decade. When bond yields go up, mortgage rates tend to go up too, and vice versa. Why does this matter for real estate investors? Because mortgage interest rates directly impact how much it costs to finance property purchases or refinancing. When the federal funds rate rises, mortgage rates usually increase, making borrowing more expensive. This can reduce profit margins or limit the amount of leverage investors can use. On the other hand, when the rate drops, financing becomes more affordable, helping investors buy more properties or improve cash flow. Now, adjustable-rate mortgages are more sensitive to changes in the federal funds rate. Their rates reset periodically based on short-term interest rate benchmarks linked to the federal funds rate. Fixed-rate mortgages, especially those with long terms like 30 years, are influenced more by long-term market factors and bond yields. So, they might not move as quickly or directly with changes in the federal funds rate. In summary, the federal funds rate influences home loan rates mainly through its effect on banks, borrowing costs, and the prime rate, which is the base for many lending rates. But mortgage rates, especially long-term fixed ones, are also shaped by broader market forces like Treasury yields and investor sentiment. For anyone involved in real estate investing, keeping an eye on changes in the federal funds rate can help you anticipate shifts in borrowing costs and plan your investments accordingly.